Awesome. So just a quick introduction. My name is Serg Rodenzuela, formerly head of strategic partnerships at Wefunder, currently a venture partner for the organization, and also a full-time founder. And here's my colleague, Jonny.
Yeah, former colleague now, but Jonny Price, I'm the VP of Fundraising at Wefunder. If you believe my LinkedIn, I'm the VP of Banter at Wefunder. I've been in the company for 6 years, and yeah, excited to tell you guys a little more about community rounds, as we call it, the idea of letting your customers and community invest in your startup, as well as VCs and accredited investors.
So I guess the most obvious question right now is, what is Wefunder?
Yeah, so Wefunder is a platform that helps startup founders raise capital from unaccredited investors as well as accredited investors. We use an SEC exemption, a way of raising money called regulation crowdfunding. So as you guys may know, like most startups in America today are raising through this exemption called Regulation D. Usually Regulation D, one, is limited to accredited investors. So you have to have 200K of income, 300K household income, or $1 million of wealth, excluding your primary residence, to be able to invest in private companies. And also Regulation D typically is limited to private solicitation. So you can't talk about your raise on social media or send an email blast to everyone you know, like your customers, for example. And so with Wefunder and this regulation crowdfunding exemption, we changed both of those things. So now to raise money, you can market the fundraise in whatever way you want to. And you can also open it up so that any of your customers and community members can invest, even if they're not accredited. So
just to clarify a little bit better, for those that might be first-time founders raising for the first time, or maybe even some potential investors, what is an accredited versus an unaccredited investor?
The two-word answer is that accredited investors are rich people. I think it's about the richest, maybe 10% of the population. Technically, if you have 200K of income for 2 years in a row, you're accredited. Or if you have $1 million of wealth, excluding your house, then you're accredited. So, yeah.
And why is this important? Like, why should people care about unaccredited investors being able to invest into privately held companies?
Yeah, so Wefunder is a public benefit corporation. That's how we're incorporated legally. It's kind of cool if you guys know about PBCs versus C Corps or LLCs. A public benefit corporation allows you to have a mission, a charter that you're legally obligated to uphold, as opposed to a C Corp being focused on maximizing shareholder returns as the legal obligation. So our kind of PBC mission is focused on both the investor side of the marketplace and the founder side of the marketplace. So on the founder side of the marketplace, the idea is to make it a little bit easier for founders to raise capital. Wefunder is based in Silicon Valley. I lived in San Francisco for 10 years. Sergio's been in San Francisco for the last year. If you're a founder in Silicon Valley, it is, relatively speaking, very easy to raise capital. There is an abundance of VCs, tons of angel investors, super rich capital networks. If you are in Indiana, relatively speaking, it is much, much harder to raise capital. 77% of venture capital in America today goes to 3 states, California, New York, and Massachusetts. And so a big part of the law that was passed in 2012 called the Jobs Act, which is the legal framework for what we do at Wefunder, and a big part of our mission at Wefunder is how can we democratize angel investing, empower hundreds of thousands, right now 350,000 people have made an investment, but hopefully in the coming years, millions of people throughout America, outside of Silicon Valley, New York, and Boston, to invest in startups in their communities, to invest in their friends' startups. We do Main Street businesses like breweries and distilleries and coffee shops and restaurants. We do movies and sports teams and also tech startups. So a big part of the mission is get more capital flowing to founders throughout the country, especially in places or to maybe demographic groups that have historically not been kind of well represented or have had more of a challenge raising capital. Then on the investor side of the table, the idea is, why should only millionaires get to benefit from the next Uber's IPO? Capitalism is creating all this wealth, but more and more wealth creation as companies are growing is happening pre-IPO. It used to be the case that the vast majority of wealth in like Microsoft market cap today or Amazon is post IPO. Increasingly, with more venture capital available, more of that wealth creation is happening pre-IPO. And so the kind of idea for Wefunder on the investor side is let more people participate as angel investors in startups they love, even in the kind of, early rounds. And also, I think, kind of build more cohesiveness and connections and community around those startups, more kind of relationships between founders and their customers and community members who are now able to invest in them, which previously wasn't possible. For 80 years, the securities laws of the US didn't allow you to invest in companies unless you were accredited. I think it was the 1932 Securities Act. Basically said you had to be accredited to invest in a risky early stage private company. The Jobs Act of 2012 was what, after 80 years, kind of changed that.
So there are a couple interesting things I'm going to dissect out of what you said, because I want you to elaborate a little bit more. But you mentioned, I guess the overall theme is the democratization of private investment to the middle class, or not wealthy folks. But then the other thing was 75% of capital is concentrated in 3 states, right?
77, yeah.
77. So could you provide a few examples of what democratization of investment looks like, for example, on a platform like Wefunder?
Yeah, absolutely. So one cool example is this company, Mercury Bank. I don't know if any of you guys bank with Mercury. They're a relatively new banking platform, really initially focused on startups and providing banking services for startups. And in 2021, I think it was, they raised a very large Series B, $120 million. I think Co2 were the VC that led it, Andreessen Horowitz invested. And they said, this is cool to raise from some of the best VCs in the world. Wouldn't it also be cool if thousands of our startup founder customers could become investors and owners on the same terms as Andreessen Horowitz? So they opened up a $5 million, which is the legal maximum that you can raise every 12 months through this regulation crowdfunding exemption. So they opened up a $5 million community round allocation on Wefunder, and 2,500 of their customers fully funded that, massively oversubscribed in 24 hours. So that's a really kind of sexy example of a company allowing their community and customers to invest, not because they need the money, actually. A big part of Wefunder, like I was saying earlier, is to help founders make it a little bit easier to raise capital. For Mercury Bank, it wasn't about raising capital. For them, it was entirely a customer engagement campaign. It was a marketing campaign. And if you look at some of the investor notes on Wefunder from people that invested in that company, I think we actually made a book and sent it to Imad, the founder of Mercury, with a bunch of these investor notes. And I imagine he was pretty proud to kind of read those notes. That's really what this is all about.
So, I mean, that's obviously, like, in your words, a very sexy example, right? But I don't suppose Wefunder is exclusive to the Mercurys of the world, right?
Yeah, so I live in Nashville. I drove up yesterday, and in Nashville there's a restaurant called Bad Idea. This guy was the sommelier at another really nice restaurant in town called Bastion, and he was striking out on his own to open this wine bar and restaurant. It's a great name for a bar, right? Bad Idea, best name for a bar. And he went to his network, his community, and raised $700,000 from a couple of hundred people on Wefunder to open the restaurant. And one thing that I think is really cool is he's told me a lot of those investors are regular customers of the restaurant. He actually, I think, gave them perks where maybe they get a free appetizer when they come in if they invested $2,000 or something like that. So you can do these perks as well. But that's a really good example of a Main Street business.
Yeah. And
I think he found the experience quite an easier way to raise capital. One example of that I kind of always think about is I am technically an accredited investor. My wife and I just did a big renovation on our house. I don't have millions of dollars to invest in risky startups.
Right.
For me to write a bunch of 25K checks into my friends' startups or into kind of early stage startups, probably can't write too many of those in a given year. But if I can lower that check size to $1,000 or $2,000, then whatever kind of allocation of my investment portfolio I want to deploy to investing in early stage startups, I can kind of spread that around and kind of take more bets and mitigate my risk through portfolio diversification.
That's pretty cool. So for founders that might be contemplating or exploring this idea of a community round, like, are there things they should know, before they raise a community round? Like, what is the community looking for? Because when you think about this company is quote unquote VC backable, venture backable, or this company can raise venture investment, or they can apply or qualify for grant financing. So when you talk about community round, like, what does that mean? What qualifies you to be able to do that?
Yeah, and it's a good point that you mentioned about the venture capital funding, because there's obviously a number of examples on Wefunder right now. If you go to wefunder.com/explore, you can browse through. It's probably a couple of hundred of companies that are raising right now. And some of them have raised money from VCs, and they're doing kind of what Mercury did, or Beehive is another example, with 32 million Series B, led by NEA, and then did $1 million community round, let their riders invest. So there's these venture-backed companies. But one of the things I'm really passionate about is that the venture capital model, right, and VCs, as you guys probably know, like, they only want to invest in companies that have $1 billion exit potential, right? Power law upside. And that is a tiny, tiny fraction of companies that are started in America every year. And so I'm excited about the proliferation of, like, more investment structures that can be a better fit for enabling more companies to raise capital. And so on Wefunder, yes, we can do a say for a convertible note or price round into a kind of venture backable or like venture path company. But we can also do a revenue share investment or a standard loan investment. The Bad Idea restaurant I mentioned, they had kind of a standard like equity flip contract that is very common in like investing in restaurants locally. So you can use kind of different investment structures on the Wefunder platform. I would say to your question on like what you should know as a founder if you're considering raising money in this way, for me there are kind of two use cases for Wefunder. Kind of already alluded to them, but the first one is we don't need money, but we're maybe a consumer-facing company, and we just think it's really cool to let our community and customers invest in our startup as like a marketing campaign. So that's kind of use case number one. Our vision is that every consumer-facing company in the coming years sees it as a no-brainer to allow their customers to invest in every round, alongside and usually following on from VCs pricing the round, leading the round, if they're on their venture path. The second use case is far, far more common on WeFunder, which is, man, it's tough to raise capital in 2024. Like, maybe if I'm an AI company like yours, then it'll be a little bit easier. Maybe if I'm in Silicon Valley building an AI company and, my last startup exited for $2 billion, great, no problem. But I think the vast majority of founders, especially in 2024 versus like the boom years of 2020 and 2021, are finding it tough to raise capital. And investors are looking at the stock market and maybe have some nervousness about writing larger checks. And so by far the more common use case for Wefunder is this is a tough time to be raising capital, and if I can market the raise, if I can raise from unaccredited investors as well as accredited investors, about half of investment volume on Wefunder is from accredited investors, and if I can get in front of Wefunder investors who typically maybe bring in about a third of the capital. So maybe if you as a founder can go to your network and bring in 200K, maybe expect Wefunder's investor base to bring in 100K. But in those ways, marketing the raise, unaccredited investors as well as accredited investors, Wefunder's investor base, hoovering up a bunch of small checks rolled up to 1 SPV on the cap table, we hope we can make it a little bit easier for founders to raise capital, even in a tough fundraising environment like this one. You
mentioned, or you had this focus on consumer as you were giving your answer, and I'm curious for founders that are not direct to consumer, like they're not building direct to consumer companies, should they consider Wefunder? And Mercury, by the way, is not a consumer company.
Right. Mercury at the time was B2B. They've recently expanded into personal banking, more consumer facing as well, which is cool. But yeah, they were B2B, and for sure, like as a B2B company, right? Maybe you can have benefits by, people that work at companies that you would love to be selling into. If you can kind of put a bunch of investors into your target companies, then maybe that might help with the kind of sales motion. So it can definitely work for B2B. I think it's like more kind of suited typically for B2C. For me, for B2B companies, it goes back to that second use case of, if it's like, I'm talking to one medical device company right now, and they've raised, I think it's 1.2 million, and it's taken maybe 8 or 9 months, and they've just been doing the angel circuit, and it's been a grind and so many meetings, and now they're coming to try to do another 500,000 on Wefunder, and I think they're quite excited about, like, all of those investors that they chatted with previously maybe didn't want to invest 25K in a Reg B round, but they can come and maybe do a smaller investment in the Wefunder round. It's just an additional avenue for them to raise capital, again, get in front of the Wefunder investor base. And so that's a good use case for me. Like, fundraising's slow, there is some momentum, but we've tapped out on network, it's a grind. This can be a way to kind of push the gas pedal on the rate.
So as someone who is considering doing a community round myself, how do you think about the interactions between combining fundraising strategies, right? So like, I'm VC backed, right? Why should I or shouldn't I?
Just have to get that in there. So you should maybe get a badge, just walk around the conference.
Yeah.
Yeah.
But yeah, I mean, because founders, right? They have this idea that doing a community round may potentially hurt them in raising VC or venture capital, right? So what do you say? Like, what do you say to that?
So, I mean, I remember in Nashville, we were chatting about this maybe 6 months ago.
Right.
You said this, like, I think there's a lot of misconceptions about how community rounds work. So when the law first went live, the Jobs Act was passed in 2012, and then the SEC rolled out the regulations in 2016. So May 2016 was a seminal moment in the history of investment crowdfunding. That was like the first time since the 1930s when the unaccredited investors were investing in startups. And in those early years, 2016 through 2021, there was a huge problem with this way of raising money, which was that if a company raised from 200 people, that will be 200 lines on their cap table, which any VC will get very kind of agitated about.
Right.
In 2021, the SEC made some really important improvements to the laws. So they increased the cap from 1 million per year to 5 million per year, and they allowed for SPVs to roll up investors to 1 line on the cap table. But I think some people, maybe VCs, are kind of stuck on, oh, that screws up your cap table, right? So whereas that problem is now solved. For me, it depends a little on the motivation of why the founder is running the community round.
Right.
If they are running the community rounds because they are struggling to fundraise, then sure, there is a risk of that being a negative signal. Although for me, good VCs should invest in companies that are going to make their LPs a ton of money, as opposed to kind of where the money came from in the last round.
Right.
But just as with, if you have a good VC in your last round, that's going to help with making it easier to fundraise in your next round, right? But if the motivations are good and transparently, obviously clear, so for example, if you're a consumer-facing company, I think it's very easy to explain why you did a community round. Right? It's very easy for Substack to explain why they did a community round. We just wanted to let I think it was 7,000 of their users become investors. It's a community building play. For you, I think, and we'll talk about this later, but for you, I think your motivation and interest is kind of what I was saying earlier, like the next Uber, wouldn't it be cool if 1,000 drivers had become millionaires at the IPO?
Right.
You letting your kind of friends and family and community invest in the early rounds is kind of a cool way for them to be able to participate in the journey, like hopefully benefit from your success. But I don't know, I kind of turn that question back on you. What's your motivation for wanting to potentially do a Wefunder round?
Yeah, so I love the ethos of what Wefunder stands for, of democratizing investment to the middle class. Before I started my last company, I did not know that venture capital existed. I didn't know that the whole startup ecosystem existed. And when I dove in it, I realized, like, whoa, like, this is, like, what a cool opportunity that an immigrant like me can come to the United States, start a company, build generational wealth, like, create jobs and do that whole thing. but how unfortunate that only the top 1% of people can participate in that experience, right? So I really do love the fact that me as a second-time founder, I can now open that opportunity up to not just the investors that backed my last company, but also to my family, my friends, fellow founders, right? I also like the idea of doing it as a marketing campaign, right? So for me, being in like literally like day zero, right? This is the first month operating my company full time, and realizing, you know what, this is a little mini army that I'm building from the very beginning, and I don't know the synergies yet that will come out of this mini army, but a year from now, potentially one of my backers, even if it's a tiny like $100 check, $1,000 check, they might know maybe somebody who can become the largest customer for me, and that could really change the paradigm of what I'm building. Because you never know where a lot of opportunities are going to come from, and from my perspective, I'm just diversifying, right? Because I could put all my eggs in the VC basket, and then I have one VC on the cap table, and I have all of his network, but I could also diversify, the type of support and the financing that I get as a founder. Also, selfishly, I think it's a little bit of a flex to be able to do it and to be able to say, hey, I don't need the money. I'm doing this because I want to and because I can. And to your point, not all founders are in that position. But I think for me, it's a cool thing that I would love to be able to do in every subsequent round of financing for the company.
And in terms of sequencing, so you had already raised a VC check.
Right.
Was that important for you to kind of have that done first before then opening it up to let your community invest?
For me, yes. I don't want founders to think that they have to do that though to do a community round. For me, it was important because I think the coolest part of Wefunder is letting unaccredited investors get in at the same valuation as an institutional investor. So for me, having the institutional investor allows me to actually make that true. Also, and this is just a personal opinion, I believe that valuations, the conversation and how much is your company worth, especially at the pre-seed seed stage level, that conversation should be had with an accredited investor, somebody who invests professionally, not my uncle, right? Or like a family friend that's willing to write me a $5,000 check. Like, I'm not saying that's not something that founders should consider or do. Like, every situation is unique. But for me, having a Bay Area investor say, hey, this is how much money, I'm putting a significant amount of capital into Sergio's company at this valuation, is a really strong signal, which I then can follow by saying, and I'm also going to let the community invest alongside them.
Totally agree. And then the community round will go better because you have that validation and that signal and that lead check. As with all fundraising, right? Any fundraising round goes a lot quicker when you have the lead investor. And Sergio's situation is actually a little different. So I said kind of two use cases, right? One is like let your customers invest. Two is because you need help raising capital. Yours is actually cool, and I think I would say noble, which is like you're kind of like you just want to share this opportunity with your community,
right?
Like it's almost like a gift to your friends and people that have supported you. Which I think is really cool. I would say that's rare, maybe.
Having said that, I do want to bring attention into the risk associated with investing this early, right? Like at the end of the day, I personally believe angel investing is not too much different from going to the casino and gambling your money away, right? If you don't take a portfolio approach, if you're not what we call like a sophisticated investor, if you don't know what you're doing, if you're literally only investing in your one friend and you make one bet, the likelihood of that money going to zero is like over 95%. So like having said that, just like I wouldn't think of it as a gift per se, because the likelihood of people losing money and this investment is, the likelihood of that becoming anything is very, very low.
But at least you're giving them the gift of the option.
Yes.
Right?
And I think that's what
opportunity. You're not like preventing them from having that opportunity.
And I think that's what democratizing private investment is all about. Is I don't think it's okay that only one group of people, one socioeconomic class has access to this. I do think something that is lacking in the community round space or in the crowdfunding space in general is this educational component of, okay, now you have the opportunity, but now that you have the opportunity, here's the education that comes along with that opportunity, and here's how you make smart investments. Here's how you do proper diligence, right? It's not just your buddy is doing a community round, so you should give him money. I mean, you should really think of that as a donation from my perspective, unless you're thinking about it as, hey, I'm going to build a portfolio, I'm going to do a little bit of diligence, I'm going to do some market research, and I actually really want my community that is invested in my company to not just have the access or the opportunity. I also want them to have that education and to know, hey, this is the first investment that you get to make, but here are a bunch of other opportunities on the Wefunder platform.
Yeah, we have something on the Wefunder homepage that talks about investing in startups being like buying socially good lottery tickets, which I think is kind of a nice way of putting it. I also just want to kind of touch on maybe two additional downsides. If you're a founder considering raising capital in this way, there are kind of two downsides to regulation crowdfunding versus regulation D. The first is it's more expensive. So Wefunder and there's other platforms as well, like they charge a fee. It's a little bit more of an expensive model for us to administer a lot of kind of maybe thousands of smaller checks versus like one $1 million check. So in terms of the percentage cost of capital, like Wefunder's starting fees are 7.9%. That's a pretty expensive way to raise capital versus like Angel List, which is, for example, a lot cheaper if you're kind of on the Reg D world. And then the second thing is around the financial disclosure requirements. So if you're raising through Regulation D, obviously you're sharing financials with investors, but you don't need to publicly share financials. The SEC says that because retail investors are participating here and they need to be protected to a greater extent than accredited investors, companies that are raising through regulation crowdfunding need to share financials. So if you've been around for more than 2 years, share 2 years of financials. If you're a newer startup, just going back to incorporation date. And then depending on how much you're looking at raising, they can be self-reported up to 124K, reviewed by a CPA up to 1.2 million, audited by a CPA if you're raising more than 1.2 up to 5 million. And getting an audit might cost you 20 grand up front, but also those audited financials then need to be publicly filed with the SEC's EDGAR database. And so then your competitors or your customers or anyone could go to your SEC filing and see, okay, Koala's revenue in 2022 was so much money, in 2023 was so much money. So there is more kind of public financial disclosure requirements with regulation crowdfunding, which for some founders, if they're like in a really competitive industry and they wouldn't want like competitors to be able to see that information, that might be a deal breaker for them.
No, I'm really glad you brought up the nuance and financial requirements and the potential cost. Interestingly enough, I'm actually in a position where if I have 5 accredited investors that want to give me $10,000 each, like 50K, it just so happens that Wefunder is going to be half the cost of doing that on Angels List. But there's definitely like a threshold, like once you pass that threshold, doing the community run,
it becomes more expensive.
It ends up being more expensive. But having said that, because when I was at Wefunder, I would get this question a lot, like, oh, why should I use Wefunder? Why not Angels List? But I always go back to, well, Angel List works exclusively with accredited investors. The ability to let unaccredited investors invest in your company is something that you can only do through a funding portal like Wefunder. And of course, there are other competitors. But my favorite part of Wefunder, and the reason why I'm team Wefunder versus any other equity crowdfunding out there is, is not just you, Jonny, but it's also Wefunder is actually the only equity crowdfunding platform in market, and I can say this confidently because I did a lot of research before I took that job. They're the only ones that don't charge you a penny until after you raise the money that you need. All the other platforms ask you for an initiation fee, like a 5K onboarding fee. If you need to change the goal, there's a material amendment fee. They have all these different kind of like predatory or a la carte like fees when Wefunder's approach is, hey, test the waters. See what happens. If you don't raise any money, that's okay. It doesn't cost you anything other than your time. And I know time is a valuable resource, but that's a huge pro for me as a founder.
This is a little in the weeds, but you just mentioned testing the waters. Another part of the 2021 SEC rule changes around regulation crowdfunding was to allow for this thing called testing the waters. Before 2021, it used to be the case that you needed to get the financials reviewed by the CPA before you could then file this legal document, a Form C, and only when you file the Form C can you then start sharing about the fundraise. Since March of 2021, you can now flip the order. So you say, well, I'm not going to get the financials done yet, or I'm going to start working on them, but maybe that's going to take a few weeks. And in parallel, during that time, I'm going to spin up a page and start sharing it with people and start fundraising in this testing the waters mode. Some companies, as I say, most companies will use that to just parallel process. So if it's going to take you a month to file the Form C and a month to raise the money, then you can do both things in the same month as opposed to taking 2 months to do it in series. There is also another kind of use case for testing the waters, which is I don't know if I want to do this community round thing. I don't know if there's going to be enough demand from my customers to invest. So I'm kind of, as the name implies, I'm going to float a trial balloon, see if there's enough investor demand. And if there is, okay, then I'll go and pay the CPA and do the legal disclosures and sink my time into formally kind of closing the money. You can't close on the money until you've filed the legal paperwork, but you can start fundraising and collect reservations to invest, which then become investments upon the filing of the legal paperwork.
And that's definitely one of my favorite parts, because as a founder, being able to control the narrative and being able to have flexibility to hedge my bets, because if that doesn't work, I don't want to have all my eggs in that basket, right? So it's important for me to just have multiple options, and Wefunder is just another financing option, which I really do appreciate.
That's actually, just to double down.
But I'm going to stop you after that. So last thing, because we want to let the audience ask some questions.
But you just said something which I think is kind of another use case for Wefunder. Again, especially in this environment, I've heard a lot of stories, right, of founders talking to investors, and those conversations drag on, and during that time, the founder's runway is kind of coming down and down because they're losing money every month. And that's kind of every month that goes by is increasing the leverage of an investor, because that founder then has less runway. And so then maybe the investor can squeeze a lower valuation out of that company. I've seen, actually this week I saw 2 safes with 1.5x liquidity preference.
Wow.
Which I feel like I haven't seen in
that's crazy.
years. So sometimes maybe another use case for Wefunder is, well, I go to my customers, I raise a couple of $100,000. That gives me a little bit more kind of breathing room from a runway perspective, so that I have a little more leverage in those conversations with institutional investors.
Oops. Awesome. Well, I do want to open up the floor to you guys. Raise your hand if you have any questions. I have a mic here that we can use. So if you want to learn more about community rounds, or maybe you have a question unrelated and you just want to have a fun conversation, the floor is yours for the next 10 minutes or so. So, yep, okay, over here. Oops, there you go.
Is this on? Okay. If we have a group of investors that want to put in money, we don't have a founder to invest in yet, but we want to choose one, is that legal under the community funding?
What a great question. More questions like that, please. Where do I send my money? What I would recommend is maybe, I don't know, on a Zoom call or in a meeting, or however you're kind of getting together as a group. If you want to, you can browse through different companies on Wefunder and choose one that you like the look of, and either each of you can create individual investor accounts on the platform, or there's also a place where institutional investors, like a fund, for example, you could kind of pool the money in an LLC, and that fund could be the kind of investor account on the Wefunder platform. Does that answer the question?
If we wanted to do it without Wefunder, can we do it?
Yes, you can. That's a less fun question, though.
Well, no, so I actually have a better answer, I think. Of course you can do it, but it does mean you have to hire your own legal team, and you have to figure out a way to bring that money into your bank account. I think the reason why I'm using Wefunder, because I'm a technical founder. In theory, I could do this myself if I want to. I just don't have the time to do that. I'm building a company that is in a totally different industry. Wefunder spent the last decade building infrastructure to take payment from any major bank and credit card organization that exists nationally and internationally. So that platform is already there. And then all of the legal work, filing the Form C, figuring out what is compliant, what is not. I just don't want to have to do that work. but mostly what you're paying for really is convenience and time. Could you do it yourself? Of course you could do it yourself, but you will have to probably hire a legal team. I mean, you probably should, and then you would have to figure out how to bring that money into the account. And you're talking about potentially $100, $500 checks, right? So it's just probably not worth it.
I will say, like, if you're all accredited investors, then it becomes a lot easier, and then you can use
Right.
a accredited investing platform. AngelList is the most famous and biggest one. AngelList is using Regulation D, and with AngelList, there's a lot more kind of flexibility for that kind of stuff. With if you're accredited investors, but with unaccredited investors, yeah, regulation crowdfunding is the path. And for regulation crowdfunding, you do need to use like a platform like Wefunder or Republic's another good Reg CF platform.
Awesome. We have another question here, and then we'll go to you.
Hi, my name is Shweta, and I am currently in the pre-seed part. And I had a question about the VC funding versus the crowdsource funding. Is there a specific ratio that you will need to have that VCs will want, like 85 to 15 or something like that? And secondly, what happens when you have an exit? What happens to the investment at that point? Because that's
I'll answer the first part. You can take the second part.
Yeah.
No, there's no specific ratio. This is my opinion. My opinion is that you would want to see more institutional financing than community financing. Now, having said that, I'm building a tech company in the AI space, right? If you're building a coffee shop or a brewery, the ratio will likely be the opposite, where you actually want the community to be 90% of stakeholders because they're going to be the ones purchasing and visiting your location, right? So it's on a case-by-case basis. I don't believe there is a ratio that people want, but I would say from an optics standpoint, if you're building a tech company and you're building a venture-backable, venture-scalable company, you likely want the ratio to lean more VC versus community.
Yeah, I will say that sometimes raising the money is better for you than the signal of whether you had an institutional investor lead and price the round. And if institutional investors are not going to invest in you because they want to see more traction, then you have the choice of, well, either I'll continue to bootstrap and make more progress on the product, which is usually the right answer. Like oftentimes, often maybe capital is not actually what you should get. But if you do need capital, and institutional investors are kind of not yet ready to invest because they want to see that you're further along, then at that stage, I would say the raising the money trumps kind of what Serg's point around, like the majority of the money coming from institutional investors. So
yeah, and obviously that's like what would be ideal, but like obviously between running out of business and having a bad quote unquote ratio, I'd much rather have a bad ratio than close down my company. So you also have to take that into consideration. And no company is perfect. In fact, a lot of companies, when they get to their Series B, they have to do like a cap table, like reorganization, because of the founders have either taken too much dilution or like somebody has too much control. So it's not unusual for the cap table to be revisited and restructured after a Series A or a Series B. So I would not, to Johnny's point, do what you need to do. Stay alive, right?
that comes to the second part of the question.
Yeah,
Is
the exit. Yeah.
when you go to the exit,
Right.
how much do the community have a say in how much you sell the company for?
yeah, so the way Wefunder works is the SPV that we set up may have hundreds of investors in it, but you as the founder designate one syndicate lead investor for the SPV, who basically votes on behalf of everyone in the SPV. So oftentimes that's like an experienced angel investor, can be a VC. Iggy Pop, the musician, was the lead investor in Detroit City Football Club, which was a fun one. Yeah, they're kind of featured on the page, and they're casting the votes on behalf of everyone in the SPV. And then from a payments distribution perspective, you would send, and I presume that AngelList SPVs work in the same way, you would send one payment to Wefunder, and then we take care of allocating the payments to the investors on a pro rata basis.
Right behind you.
Hey guys, Tyler here. You guys spoke a little bit about how bringing on a larger investor can increase momentum and interest from community investors. Can you maybe speak to the opposite of positive or negative impacts of community investment as you look to secure more traditional venture-backed investment?
Yeah. At the end of the day, there's nothing better than traction. And when I talk about traction, I don't mean like you got Andreessen Horowitz in your cap table. I mean like real paying customers growing ideally double digits month over month, right? So in terms of positive or negative signals, that is going to be the strongest signal that you can get.
100% agree.
Like period, right? So that should really be your only focus. Now, having said that, as a founder, it is your job to be a master storyteller, right? So I could decide, you know what, I don't want to do a community round, it's too risky, I don't like the optics. Or I could say, you know what, I'm gonna turn this into like the coolest story and I'm gonna make this into a positive signal and I'm gonna show VCs that I'm so early, but I still managed to get some of my early supporters to back me. And it's a narrative game, right? I have a framework for fundraising where I say fundraising is a game. If you guys didn't know that it's a game, like sorry to break it to you, it's a game. And it's a three-part game. It's a narrative game or a storytelling game. It's a relationship game. And it's also a numbers game. And it should also be a full-time job, you know, while you're fundraising. But it's really a game, and a lot of founders, first-time founders, are not good at playing that game. So when you talk about signal, like yes, like we could make a table about this is a positive signal, this is a negative signal, this is how they're weighted, this one's worse, this one's better. But now you get into a place where it's all very subjective and it's very opinion-based. I think the most useful thing I can say is just whatever you end up doing with your company, figure out a way to tell that story in a compelling way, right?
I'll just build on that because I totally agree on the traction point being
Right.
what hopefully good
Right.
investors are going to invest on.
Right.
And I would say that this kind of goes back to your question. Like, if raising money can help you get more traction, that's actually going to make it easier to raise from VCs in the next round.
Right.
Especially if you believe, as we do, that if you have whatever hundreds of customers and community members invest, they're going to be your marketing team and they're going to help you to kind of grow the business in other ways. But yeah, look, you know, would an investor in a Series B prefer that, you know, Andreessen Horowitz invested in the Series A versus like a community round? Sure, Andreessen Horowitz, like every VC would prefer Andreessen. They would also prefer Andreessen to like a second tier or a third tier or a fourth tier VC. And for me, it's not a binary thing, right? It's like that's Beehive, great example of the positive signal. So on April 30th of this year, they announced a 32 million Series B led by NEA. On May 1st, one day later, they opened up a $1 million community round, oversubscribed it in 2 hours. I think it was like maybe 800 of their customers. That emphatically positive signal. And they have both. They have NEA as the lead VC in the round, and they also can spin that narrative that you're talking about of like, hey, we did this as a community engagement campaign. Rich White is the founder of Fathom. They're live on Wefunder right now. Same playbook, just raised the VC round. Now opening it up to let the customers invest. AI kind of note-taking app. He's described his previous Wefunder round as the best marketing campaign he's ever run.
So I do want to provide a different example though, because these are like obviously companies that raise a bunch of VC backing and then did a community round.
Yeah.
What about the companies that raise mostly from the community, right? I spent a year on WeFunder and I saw a little bit of everything. And one company that was really interesting to watch was a company called Nopalera. This was a Latina founder that was, she built a shampoo brand made out of nopal, which is this like cacti out of Mexico. And she had some VCs on the cap table and was not able to raise a continuation round. So she came to WeFunder and her investors told her, don't do a community round. If you do a community round, no VC or serious VC will back you. And they told her this. And at the end of the day, she needed the money to continue building and growing. And actually, it was a healthy company. It was growing. It's just the VCs were getting cold feet. The economy had shifted.
CBDs.
So, yeah. So what did she do? She did a community round anyways. And then the investors that said they wouldn't back her or told her not to do it, as soon as she raised the community round, they came in with an extra $300,000 because they didn't want to get diluted. So it's just like really interesting. Like at the end of the day, what is actually binary is what happens, right? They can tell you, no, don't do it, it's a negative signal, or actually this is a positive signal. from my perspective is, if you're getting money wired, that is the only thing that matters, right? Like the money that you see in the bank, that's real, right? Everything else is just opinions.
Thank you.
I think we're at time.
Yeah,
Thanks so
we're
much
done.
for listening. Feel free to chat to us after if you have more questions about how this stuff works, and enjoy the rest of the conference.
Thank you.